Welcome.
Hey, patients.
Hey, Angel. Welcome, Derek.
Hello.
Good to see you.
Good to see you as well. Thank you.
Thank you. I appreciated touring Vision Houses, transitional housing on the ground. Really impressive work.
Thank you. Wonderful to have you and share about what we're doing up here in Renton and Shoreline.
Yeah, exciting. Hi, John. Good to see ya.
Oh,
Hello. Vanessa from San Diego. Are you with us, Vanessa? She might be muted. Hi, Cliff.
hey, patients, how you doing?
Doing great.
Excellent, excellent. It's a lovely day today.
Beautiful day.
Hmm.
It's gonna get sunnier, so on the way up.
I know, right?
Yeah. Hi, Kristen.
Mm.
Hello, how are you?
Doing good. How are you?
I'm good, except my phones all started ringing right when you said hello.
That happens. That happens. Brian, how are you? I know there's so many Brians.
Great down in sunny San Luis Obispo today.
Oh, nice.
Yeah,
Nice. It's way better weather.
yeah, just had a walk on the beach. We're down here picking my son up from school. So
Well,
Beauty.
Brian, that's great. My kid is just finishing up down there too, and her dad is right where you are, except he probably didn't walk on the beach.
very nice.
Nice. Alex, you doing good?
I am doing good. Thank you.
Yeah. Great to see you.
Good to see you.
Well, great to see everybody. We are going to jump right in. So, Kate, over to you.
Yeah, thank you. Well, happy Pride Month and welcome to the most anticipated quarterly member meeting of the year. So first off, want to welcome you all here, appreciate everyone showing up. This is what I love about our affordable housing community and your continued support for each other. And we'd like to thank our quarterly member meeting sponsor, SRM. All right, so our agenda for the business portion of the meeting is going to be super quick. We'll be voting today on some new members and the meeting minutes from our last meeting. This will be an online vote, so everyone please vote. I will also remind you of the instructions when we get to those. And then we will quickly move on to the annual public funders panel that you're all here for. All right. Just for your reference, the packet for the quarterly member meeting minutes were sent out ahead of time. The meeting packet has also just been dropped in the chat. So I'd like to introduce our new member candidates that we'll be voting on today. And first is One Drop. Is Dom on the call? I don't see them on the call yet.
I'm actually here.
Oh, there you are.
I'm here from One Drop, but Dom is supposed to join as well.
Okay. If you want to go ahead and just give a quick overview of One Drop, that'd be great.
Yeah, so One Drop really is a collective to democratize real estate development. And so I think they've been doing a really good job. I'm sorry I wasn't prepared to speak today.
That's okay.
Are there any questions?
No, I think that's great. Thank you so much. All right, our next member candidate is the Congolese Integration Network. Do we have Francois on the call to give a few words about your organization? All right, well, I'll just read off real quick. So it's a community-led nonprofit organization based in South King County, dedicated to serving refugees and immigrants. And they're focusing on fostering social, economic, cultural, and spiritual integration by providing essential resources and advocating for the health and well-being of our communities. So really excited to see them become part of our membership. All right, and next is Healthy Smart Homes. Do we have Tracy Brown on the call?
Hi, yes, this is Tracy Brown. How is everyone this morning on a
Doing
beautiful
great.
sunny day?
Great.
My name is Tracy Brown, and I'm the board and founder of Healthy Smart Homes. And we were established initially in Massachusetts in 2024, and then now here in Washington State. But we've evolved to advocate and support home and commercial real estate ownership and work in partnerships with nonprofit and government agencies. We want to minimize transfers of wealth from communities that are highly adversely impacted, especially during economic downturns, pandemics, and cyclical gentrification. So we're currently here in Washington State. We have been since 2020. And most recently, we're working with the Department of Washington State Housing Finance Commission on the Covenant program. And so we're just glad to be a part of this network and this group.
Great. Thank you so much, Tracy. All right, and next we have Merchants Capital. I don't see JW on the call. Patience, did you want to go ahead and introduce?
Yeah, sure. Merchants Capital is a mortgage banking firm. They are a national lender. They've come into our market and are working with quite a number of our members. And really, their focus offer is originating and servicing loans for Fannie Mae, Freddie Mac, some HUD and FHA loans, and rural development programs. They provide a full service financing for affordable multifamily housing as well as market rate. And they are thrilled to be in partnership with many of you in this community.
Great. Thank you so much for that overview, Patience. And next we have Open Doors for Multicultural Families. Is Ginger Kwan on the call? I don't think I saw her. Hopefully, as many of you know, Open Doors for Multicultural Families is a diverse and passionate group of parents, professionals, and community members. They envision that all culturally and linguistically diverse individuals with development, intellectual disabilities, and their families thrive in an inclusive society of their design. ODFM's mission is to engage and partner with their focused community by using a cultural brokerage model to navigate services, provide specialized programming, and advocate for systems change. And our final new member candidate is Pacific Northwest Women's Affordable Housing Network. Anne Malone, are you on the call?
Yes. Thanks,
Hello,
Kate.
Anne.
Hello. Thank you for entertaining our application to join the HDC of Seattle King County. We're a chapter of the National Women's Affordable Housing Network. Our chapter was started in 2023, and we exist to network, ally, advocate, mentor, be mentored, engage with the community, and provide plenty of happy hours with wine. So we're pleased to be here in community with you. Anybody can join Pacific Northwest Women's Affordable Housing Network. It's free and open to all, and we would appreciate your vote with the slate. Thank you.
Great, thanks, Anne. Okay, well, and that wraps up our new member candidate introductions. So we are ready for a vote on the slate, as well as the March 2025 meeting minutes.
Kate, this Ginger, sorry, I'm a little bit late here.
That's okay. I read through your slide, but if there's anything else that you want to say on behalf of Open Doors, please go ahead.
Okay, thank you so much.
Yeah.
I'm grateful for this opportunity to be here in this space with you all at Open Doors for Multicultural Families is a grassroots organization serving linguistically and culturally diverse individuals who have developmental or intellectual disabilities. We have been existing for 16 years. So far, in the past few years, we started to get engaged with housing development and also community development, making sure that people with IDD, that they will have opportunity to thrive in an inclusive community.
Great. Thanks so much, Ginger. And I also see that Dom did just join from OneDrop. If there's anything you want to share really quick before we get to the vote.
Yes, hello.
Hello.
Really excited to be able to be in here, and we can share a little bit of background about OneDrop. Actually, we have wouldn't usually do this, but we have a group of our members who are currently doing a training session. So I figured I'll let them say hi to everybody. Hey, you guys, everybody, just say hi real quickly on the HDC call. So hi. OneDrop. All right, awesome. So what OneDrop is we are a nonprofit, which is a collective for supporting the growth of real estate developers of color. We currently have about 20 members, and our goal is fundamentally to recognize the role that developers play in the building of housing, and that historically that's been an extractive experience and reality for people of color, and that given the role that real estate plays in terms of broader wealth building throughout our country, that if we are trying to solve the racial wealth gap, that it is critical that people of color play a role in development itself. Nationally, only 0.5% of all developers are Black or Hispanic, and 0.5% is an incredibly small number. It is representative of exactly the issues that we're trying to solve at scale. And so our goal is by equipping and training and supporting more people of color to be able to play a lead developer role in the building of the much needed housing that we have within our communities will be a game changer in terms of actually helping to solve so much of what we see as issues. For example, we know that the developer plays the role of both determining what product is ultimately going to be built on that lot, and building the team of who's going to work on that particular project. And so when we think about being able to ensure that there's more inclusion throughout that process, and that there's an intent to build more solutions that are affordable and solutions that meet the needs of our community, we just know that having representation there will be critical. So our vision is that in the next 5 years, we hope to build over 1% of the housing needed within our region. And so we are really excited to be able to be a part of HDC, and looking forward to learning more and participating.
Great. Thanks so much, Dom. All right. Thanks, everyone. So next, could I get a motion to approve the new member candidates and the March 2025 meeting minutes?
I'll make a motion.
Thank you,
approve.
Amanda Santo. And a second.
Second, Michelle.
Thank you, Michelle Moreland. All right, and so as you see dropped in the chat, there's the voting link. So everyone on the call who is a member of our organization, please go ahead and click on that link, or you can scan the QR code and please vote. All right, so I'm now going to adjourn the business portion of our call and turn it over to Patience to tee up our panel for our funders.
Thank you, Kate. And a warm welcome to our new members. We are thrilled to have you on board, and we're tremendously humbled to have you join us in the great efforts and advances of this network. We're truly inspired by your vision and the work you're doing in community. So we encourage that you plug in. There are so many ways to be in partnership in this network. We've got affinity groups, we've got dedicated task forces. The time is now for us to work in stronger collaboration, and we're thrilled to have you on board. Before we move on to the next session, I just want to take a moment to highlight two pressing issues that I believe most of us are navigating, most of us are thinking about. We are facing an incredibly hard time. Intensified strain on our housing systems, on our homelessness response system, and on the people and organizations that are represented here holding it all together. We all know that we are looking at federal investments possibly shrinking by about 43% as we're staring that down right now in the proposed budget. We've got local resources that continue to be stretched here, and yet the need continues to grow. But here's what I hope, similar to me, is that you are remaining hopeful. Hopeful not because it is easy to have hope or that grit will take us through it all, but hopeful because you have an unwavering belief in our collective leadership and our ability to come together to rise to this moment. So as we come in this conversation, let's be reminded that we have been at crossroads prior. This organization, this collective came about with the decision to realize that our collective resolve is what can truly scale us in addressing the housing shortage. So we're honored to have the incredible talents and commitments of each of you in this work. The final reflection that I will give is that, if anything, I believe this is the moment for us to even make a stronger case, particularly throughout King County, to pursue a stable, unfragmented revenue source that invests in housing, both rental and ownership, and in homelessness services for the low-income people in this region. I know it's a hard sell to be talking about that, but we have all of the pointers for a case for us to move in that direction. We've got the wealth, we've got the talent, and I believe we can do this work. We've got a table that is convened to think about pathways, and we'll be tapping all of you as that vision really becomes a reality. So it's a challenge to each of us to not be paralyzed in this moment, but recognize the collective power we have in our own very backyards. With that, I realize that for us to get there, it takes incredible coordination, partnership, and shared strategy that has never been more important than it is today. And that's why we are grateful to now turn our attention to the public funders panel and have a timely and critical conversation. Our public funders across the region and partners at the state level are really at the forefront of this work. They are shaping priorities, they are navigating the complex funding landscapes, they are making decisions that directly impact our collective ability to meet this moment. So today, they will walk us through their priorities, they will walk us through their expected timelines and key policy insights. So our work is really grounded on data, and they will take your questions. So please join me in welcoming. We've got WCRA presentation by Angel Radcliffe. I know they're not a public funder, but they will go first and provide an overview of their programs. And then we will pivot over to Jacob Richardson and Jackie Monahan at the Finance Commission. We will have Rosie Zhao and Carla Lesson at the Office of Housing. And then we have Nate Leachy and Tina at King County, and then Patrick Tippy from Arch, and then Claire Godwin from SCAPE, as well as Taylor Betton from the Department of Commerce. So let's listen in closely and make the most of this opportunity for us to just be in real-time dialogue with our regional public funders as well as our partners at WCRA. With that, Angel, I will kick it over to your slides first, and then we'll hand over to the public funders panel.
Great. Can you see my screen okay?
Yep, it's come up.
Perfect. Okay. Thank you so much, patients and HDC members. I'm really pleased to be here with our other public partners in financing affordable housing across Washington. As patients said, my name is Angel Ratliff. I'm the Vice President and Director of Lending at the Washington Community Reinvestment Association. WCRA, for those of you that might not be familiar with us, is a nonprofit consortia of lenders that was founded in 1992, and we finance affordable housing and economic development projects in Washington. We have 32 member banks across 3 loan pools with over $164 million in lending capacity. We partner with the Department of Commerce on the Washington Early Learning Loan Fund, also known as WELL. And we have a long and very successful partnership with the Washington State Housing Finance Commission and their Capital Plus loan program. WCRA's multifamily housing loan pools provide lending for the acquisition, refinance, and preservation of CRA qualified, affordable, and special needs housing. A forward commitment of up to 30 months is available for construction takeout loans. Our max loan limit per loan is $10 million. And this member bank funded pool leverages public funding and fills gaps in funding stacks. We have a variety of terms and amortization available. Feel free to reach out to me or Christine for more information on that. And I wanted to add that I'm very proud that to date, WCRA has helped create and preserve approximately 12,000 units of affordable housing across Washington state. Our economic development loan program provides short and long-term financing for the acquisition, rehabilitation, and refinance of CRA qualified commercial projects. There is a max loan amount of $5 million per project. Again, this is a member bank funded pool that can significantly leverage public funding and grants. To date, this particular pool of funds has helped create and preserve almost 140,000 square feet in economic development space, including nonprofit offices, co-located retail units, and early learning centers. The Econ Dev program is an excellent source of permanent debt on commercial condo units. We offer up to a 20-year maturity and a 30-year amortization within this program. Our Capital Plus loan program, in partnership with the Finance Commission, funds commercial real estate and equipment loans. There's a maximum loan amount of $1.5 million with executive director approval. We have a max 10-year term with an available 30-year amortization. This program has no prepayment penalty and is only for 501c3 nonprofits. This program is primarily targeted at smaller emerging nonprofits that might not be conventionally bankable. To date, we've received $21.5 million in funding from the Commission, which has enabled us to lend over $31.5 million across 66 loans since the start of this program in the early 2000s. These projects include community centers, housing, early learning centers, nonprofit offices, and facility equipment. This is one of the projects that I'm most proud to partnership because even these small loan amounts make a tremendous difference to small nonprofits. The WELL program facilitates lending for the acquisition, creation, and expansion of childcare facilities in Washington. We currently have a revolving loan fund of over $16 million. And I was just informed this morning that we will be awarded another $6 million for lending in the next biennium via our contract with Commerce for this program. The WELL program requires a 1-to-1 match of WELL funds and private funds. To date, this program has facilitated over $21.6 million in funding between WELL and private sources, with another $13.2 million in the pipeline. And this is financing a really critical need for early learning, affordable early learning in Washington State. Again, this funding source leverages other public funds such as the ELF grant for the early learning facilities, as well as WCRA member funds. Of note, I wanted to say that WCRA also offers short-term loans. Our loan terms of 3, 5, and 7 years have no prepayment penalty, which might be really attractive to some developers or borrowers in the current market rate that we find ourselves in. Our permanent loans are a great option for refinancing projects that have expiring tax credits or are at the end of their maturity. WCRA can lend to nonprofit or for-profit borrowers on affordable housing and economic development projects. And here are my details if you want to reach out with any questions. I'm really pleased to be here and just continue to exist and work in partnership with all the public funders on the call today. If there's any questions, I would take them now. Otherwise, I'll turn it back to Patience.
Thank you, Angel. Really impressed by the diversity of programs that you offer and the TAMs in supporting financing of projects. Any questions for Angel? I'm seeing smiling faces. That means you did a phenomenal job, and thank you. Any closing remarks from you?
Nope, I'm just really happy to be here. I've been here for 19 years almost at WCRA, and I'm just really impressed by our state and by our public funders and the way everybody does a lot with a little.
Yeah, thank you. We're going to move over to Jacob and Jackie and the full public funders panel. So I will hand over to the team to take it from here.
Thanks, Patience. Rosie, you with me here?
I am. I'm with you.
Awesome. Rosie and I are tag teaming the kickoff for our panel of discussion, for the presentation. Patience highlighted the team members that are going to be contributing to the presentation after us. So thank you for doing that. We are grateful to be here. Appreciate your message of hope and resilience in this time. And I think everybody should be really, I'm really grateful for the partners that I have in the public on this panel. We are trying to navigate some really turbulent waters, and we've been working together to try to offer clarity and guidance for you all. Rosie, I'm curious if you have any opening remarks that you want to make about the work. I don't see you, so I need to change my picture so I can. There you are. I see you.
Okay. We can just dive right in. I'm sure there are going to be a lot of questions at the end, and we have a pretty full presentation. Do you know who's going to be driving during the presentation?
Oh, I am. Yes, I have to work out the logistics of that. Okay, let me do that. Thanks for keeping me on track. Just to clarify, we'll please populate the chat with your questions. We are going to save them for after we get through the panel to answer them, but please use the chat function. Do you see the correct screen?
Can you make it presentation mode or full screen or whatever? Control L.
Okay, so you see.
Do Control L.
Control L.
Does it go? No.
Is that better?
That
yes,
works.
Thank you.
Thank you. This is a participatory collective response. So, Rosie, to you.
Yeah, to me, I'm just going to go kind of like across the top. So Patience teed us up very nicely. As you all know, we're really operating in a truly unprecedented environment facing a lot of uncertainty at nearly every level of the housing landscape, both in development and operating. The federal outlook is a major concern. We're really keeping an eye on that. The proposed federal budget zeroes out things like home and CDBG, and there are active negotiations happening around the tax bill, which could bring sort of mixed results. And we're also watching the impact of tariffs and broader economic trends. It's really kind of, we're in this period of volatility. And really, for anyone trying to plan long term, the uncertainty is not helping. In addition to that, as you know, support for permanent supportive housing is weakening. Block grants are being threatened. Voucher availability is decreasing. State support also is reducing, and projects in development that rely on these sources may not be viable in the long run if these sources aren't identified soon in order for them to continue on. With that also comes some constraints on our resources. Many of our partners, investors, and lender partners' appetite is also shifting for many of our projects. Pricing has dropped. Interest rates, as you know, have gone up. There's also more caution overall. A lot of the underwriting assumptions and metrics they're using have changed and shift, especially on deals with complexity or a lot of different layers of funding. And we're seeing challenges for projects to get over those hurdles and get underway and or converted to perm. All right, Nate, you can take the.
Thanks, Rosie. So, in building on that, the operations and policy challenges that we're aware of, there's been a lot of work around landlord-tenant policy, rent stabilization that is a factor for many in navigating this work. The public funders have stepped up and it provided some more focus on preservation. Commerce has some dedicated funding. We have some, King County has some dedicated fundings. Skip and Seattle have all invested in preservation. So we are cognizant of that need. We don't know, it's not to the scale that the preservation needs are, but we have been increasing a focus on that. And then in our work, the Regional Workforce Housing Initiative and the implementation plan that was assigned to us at DCHS to work on, we have completed our analysis around the financial feasibility and risk analysis. And I want to be clear, there is no there's no funding immediately available. But we know that the County Council may consider our findings and pursue an investment strategy when our report is transmitted to them. This was a focused analysis around the use of bond debt financing, and tools that we explored included debt financing, repayment through rent, soft funds, and credit enhancements have also been explored. The process represents, I think, a bigger discussion around focuses on mixed income developments, which may represent an ongoing policy shift. We shall see as politics plays out. And as we shared with our early report out, our analysis indicated that a pure rent recovery model doesn't work for low income, 80% or below, and the public resources are bound to serve projects that have a majority of low income units, restricting our ability and to serve and support moderate income, as was designated in the proviso. The motion that directed the Regional Workforce Housing Initiative also emphasized that no harm should be done to programs that serve extremely low and very low income households. And we're restating our emphasis that housing subsidies are needed for those communities, for those populations, to address the low income housing need as a priority.
And I will just say that, you know, we're kind of setting the context and the framework, but there is good news to come. And so hopefully you can get some of that from today's presentation. We're not trying to be doom and gloom, but just trying to kind of set where we are today. And most of you already know what we already just went over.
I'm trying to be doom and gloom, Rosie. I'm sorry if it's not coming across very well. Or yeah, yes, no. This is an important context setting, and I hope we can use humor and navigate this. I do not mean to be that way. So this is where we shift. We shift to what's going to be available this year, and you see all of the public funders that have rental housing financial support available this year. Home ownership funding is not participating in this presentation, but they have resources. We have home ownership resources as a part of our funding, but I see Cliff is here from Commerce, and they've got some designated resources for home ownership support. So tune in to Commerce's release of information about that, Seattle Office of Housing and others. But our focus is on our notices of funding availability, NOFAs, and that's what we're going to kick it into, is a round robin presentation of what each of our funders has available. So I'll toss it to Patrick first to talk about Arch and your funding availability.
Thanks, Arch, or thanks, Nate. My name's Patrick Tippy. I am the investments manager at a regional coalition for housing, otherwise known as Arch. We support 15 communities in East King County to award resources to invest in affordable housing, and that includes both rental and home ownership properties. And so we're going to have two different RFPs released later this month. The first will include approximately $3.5 million in local funds through the Arch Housing Trust Fund. It's a mixture of sources from general funds and fee in lieu and sales tax collections. Included in that RFP will also be including $2 million available from the city of Issaquah that's collected through the sales tax that was enabled through House Bill 1590. And the second RFP that we're going to be helping to support is going to be the city of Bellevue's advertising of up to $20 million available for both housing, capital, and operating maintenance services for the Housing Stability Program. The priority populations for that funding source is 0 to 30% AMI, though residents could earn up to 60% AMI. There are some set-asides that are involved and required with that, so please stay tuned to the pending RFP, but we look forward to answering questions that folks have. And I will be putting my email address in the chat here. If you're not currently on our distribution list to receive our RFP releases, please feel free to send me an email and I'll get you added to our list. And now over to Claire.
Thanks, Patrick. Hi, everyone. I'm Claire Goodwin. I'm the executive manager for the South King Housing and Homelessness Partners, or SKHHP for short. And we are entering our 4th year running a funding round. So to date, we have pooled over $14.5 million to support the creation and preservation of almost 700 affordable housing units throughout South King County, funded through the generous contributions and pooled funds of 11 South King County cities. So this year we have approximately $3.5 million available. And of this, we have just over $900,000 available for the construction, acquisition, or rehabilitation of housing serving up to 60% AMI for rental and up to 80% AMI for home ownership. We also have about $2.6 million available for construction, acquisition, rehab for households earning up to 60% AMI and who fall into a special population category. must be at least one of these: persons with behavioral health disabilities, veterans, seniors, persons who are homeless or at risk of being homeless, unaccompanied homeless youth or young adults, persons with disabilities, survivors of domestic violence. So our application is available June 16th and intends to apply, and pre-application meetings are required by August 4th. And I will also put my email in the chat if you are interested or have questions and want to reach out. And I'll pass it on to Tina.
Hi, everyone. Sorry, just took me a sec to find my unmute button. King County will have up to 30 million available in this fall funding round. We expect a variety of funding sources, including behavioral health funds, veterans levy funds, regional affordable housing program funds, as well as possibly federal home funds. We will additionally have equitable development initiative funds in the amount of 11.9 million, and jail divestment funds for Seattle only in the amount of 5 million. We also have transit-oriented development funds, mainly for the East King County in the amount of 5.8 million. We have several priorities this funding round, including homeless and extremely low-income housing priority, housing for people with disabilities, housing for veterans, transit-oriented development priority, including the East Side, East King County. We also have an equitable, community-driven, affordable housing development priority, jail divestment priority for projects in Seattle only, and that is to keep youth and young adults out of the legal system. It's not for people that have just gotten out of jail. We also have a homeownership development priority. And we have been holding info sessions this funding round in lieu of individual pre-application meetings. And the next two info sessions are tomorrow and also on June 18th. And so that's a little bit different because previously we had required pre-application meetings, and we're not doing that this year. We're asking people to come to our info sessions for more detailed information about our funding round and our timing. And also within those info sessions, we're having breakout rooms where developers can ask questions individually. So we really encourage you to come to one of our next two sessions. And this year we're also not having the pre-application meetings. We're also not having required intents to apply, but we are encouraging intents to apply so that we have the information about your proposed project and have more information on that in the event you want to meet with us during one of our info sessions. And that's all I have.
On mute.
And I'll pass it to Rosie.
Okay. All right. So as mentioned a little bit before, and many of you know, our NOFA for acquisitions, it was a rolling NOFA, is still suspended at this time. We really are trying to adjust our pipeline and reallocating our focus, and this really is about right sizing based on the current project readiness and our funding capacity. So until further notice, our acquisition program will be suspended. But we do have a fall NOFA happening for rental production. This will be for new production, preservation, and stabilization. We are estimating approximately $100 million that we will be announcing. We plan to publish this formal announcement of our NOFA mid-July, and applications will be due September 18th. I believe that's a Thursday. And once the publication or the NOFA is published, you are able to come in for a pre-app meeting, and I'll get to that, and that's very important to do. Also on the horizon, we expect to the Office of Housing expects to release a request for proposals for a South Park site that we have, and that will be in probably late Q4 of this year. So for this fall NOFA, please note that you are only, or sponsors are only allowed 3 applications. So only 3 applications per sponsor. And it doesn't matter what buckets you're applying to, it's only 3 total. So I'll say that again, 3 total, okay? You can choose and prioritize how you will as an organization, but you only get 3 applications. And that also includes joint applications with someone else. So if you're in partnership with another organization, that still counts as 1 application for your organization. So just want to be clear on that one. This year, I'm going to actually skip to thresholds and I'll go back to the priorities. This year, our thresholds are you must attend a pre-application meeting. Obviously, the applications must be submitted on time. They must be complete. There's no excuses or IOUs. The application needs to be complete. But one thing that is new this year is that the NOFA priorities must be met. And so I'm going to go right up here to the priorities. The first priority is actually location. The Office of Housing is prioritizing neighborhoods with little to no OH investment and/or projects in areas that affirmatively further fair housing and advance the city's equitable development goals. And if you have questions about that, the pre-app meeting, or even you can probably ping me now about whether or not your project is achieving that. I welcome that conversation and discussion. Another priority is our population. Supporting and addressing those of our most vulnerable neighbors remains a priority for the city. So we have prioritized permanent supportive housing or projects housing individuals and families experiencing homelessness. Or at least 20% of your units are serving households at or below 30% of area median income, or family-sized housing. So at least 28% of the units are larger units, 2 bedrooms or greater. And we also are still looking for readiness, and you can basically projects need to demonstrate financial readiness and feasibility through an implementable plan in order to get underway by March 2027 or close by then, because remember, like if you're coming in for the new production or production category, that could also be an acquisition. So you just need to be ready and able to get underway or closed. And then the last priority is actually leverage. And we are looking for projects that demonstrate the ability to leverage city funds with other funds, whether that be public or private resources. So yeah, and shortly after the release of the of our NOFA, we will have an info session, and I do encourage you to attend. It'll probably be about 2 weeks after we release, so I think that's I want to say that that is July 31st or August 1st will be the date. But yeah. And now it is the state. Taylor.
Thanks, Rosie. Good afternoon, everybody. My name is Taylor Burton. I'm the Housing Investment Manager with the Multifamily Housing Unit. So I lead the team that oversees the resource allocation and lending of the Housing Trust Fund for multifamily housing units. So I'll try to keep brief because the state does have the largest bucket of funding streams. So in the 2025 capital budget, the Housing Trust Fund fared very well despite the state's budget shortfalls. So for the upcoming 2025 funding round, the state will have a little over $250 million to allocate. Of that, using the geographic distribution that we've modeled, about $80 million will be available in the King County pool. So we'll have our typical NOFAs that you guys are accustomed to seeing, our housing trust fund, what we call our traditional housing trust fund dollars, as well as the Apple Health and Homes Capital and funding for IDV housing. So the state priorities for the state is new construction or new units. That includes acquisition, rehab, and conversion, construction of new units and such. One thing that we're really focusing on strategy right now, though, is preservation. We do have an aging portfolio that many of us have shared interest in. We do have our housing preservation program funds. That NOFA will come out later in the year. We're expecting that to be on August or September timeframe. But overall, very healthy pool of funding from the state and specifically for King County. A couple of things that I do want to note for the upcoming biennia that we're doing a little bit differently is our splits. So traditionally, we've kind of front loaded the first year of the biennia to distribute our funding. We're doing a little bit more of an even split because of the state's budget shortfall. We're hopeful that in next year's supplemental session will be appropriated additional funding, but we wanted to build in a backstop to that. So we'll have about a 60-40 split in the total appropriations from the 2025 capital budget between the 2 years. And that's all I've got. And there, I've got another slide further in the presentation. So Nate, I will kick it back over to you.
Hey, actually, Taylor, do you mind if I jump in for a sec?
Sure, go ahead, Cliff.
Yeah, so Taylor works with our multifamily unit. I'm actually his counterpart with our home ownership unit. It's unfortunate that seems like we might have missed a slide or it might have been a miscommunication because in this same past budget, this same biennia, we were fortunate to receive about 72.5 million for home competitive capital funding, or once you break that down and take out our travel set aside, it's about 60.5 million if memory serves. And we should be releasing our NOFA for that competitive home ownership funding, rather on July 16th, so of this year. So watch out for that. In addition to that, we plan on having a number of virtual walkthroughs as well as in-person discussions in Seattle, Vancouver, Olympia, and tentatively Burlington. And those will happen in July and Seattle and Vancouver, or Seattle in late July, and Vancouver, Olympia, and Burlington tentatively in August. Of course, all this is contingent upon um, the department having capacity to be able to stick to these dates. So all this is very early, but it looks like we will be able to stick to these dates. So watch out in on July 16th for that funding notice release date, and or funding notice release. And um, in terms of priorities, we are going to be prioritizing new construction, and particularly we're also going to be looking at unfunded projects back in from the last biennium, 2023, 2025, as well as subsidy projects. So the ones that are ready to be sold to homeowners will be high on the priority list as well. I could go on, but I don't want to take up all of our time. So yeah, I'll just pass it to our friends at WishFic.
Thanks, Cliff, and please put your website or resources in the chat if you can.
I'll put my email in the chat, Nate. Thanks.
Cool. All right, Jacob, all yours.
Hey, good afternoon, everybody. My name is Jacob Richardson. I manage the low-income housing tax credit program at the Housing Finance Commission. We've got a couple other folks on the call. Jason Hennigan, who is on the, he manages our bond program, and Jackie Moynihan is our senior policy advisor. So for our policy process this year, we'll be issuing some guidance, but no official changes to policy or plan for this year. We're shifting some things around. We'll be going with a more proactive approach in the future with more engagement planned. So look out for that. On the 9% side, we're going to continue funder coordination with the Housing Trust Fund, CHIP, the HUD 811 team at Commerce. We've been in conversations with them as well to coordinate more this year. And then, of course, the King County Public Funders Group. So we've got an interested parties meeting coming up in July. It's looking like that'll be on July 8th at 1:30. We'll be sending out an announcement for that. I'll drop some links in the chat once I finish for the 9% program and the bond 4% program. So on the bond 4% side, we're continuing the pipeline process with the tiered designations. Please apply to your local funders first. Being fully funded is a requirement to apply. Again, as we heard earlier, readiness, it's important. It's key. Unfortunately, projects are not closing as expected. And then the last point there is scoring. The scoring really reflects our values for prioritization. So, we're not looking for the minimum score. We're looking for more than that. And yeah, open to any questions. I'll drop the links in the chat. Thank you.
Thanks, Jacob. I just sent to HDC the PowerPoint, so it can be distributed to everybody on the call. So you can get these slides. You can look at more detail at what we're providing if you're not grabbing screenshots and taking notes. So you can supplement your learning. But these are the timelines that we have. We know it's multifaceted, very complex. So we are using the combined funders application and we're just making some updates to those forms to get them out to you all. I did want to highlight the Housing Trust Fund Repair Program, which is operating on a portal on a first come, first serve basis. and they've got funding available now. And so utilization of that, and there'll be a subsequent appropriation for that. So there'll be a new claims portal opening in July. So that's a unique feature this year, and I just wanted to highlight that on this slide deck, or in this slide. Cliff, I see your hand raised.
Yeah, just one thing in terms of our awards timeline. While the applications are due in September, we plan on, at least this is tentative based on our previous experience, we plan on being able to announce, or rather reach out to those who have been successfully awarded funds in December, latest January. So just wanted to just to correct that on the chart.
Thanks, Cliff. Yeah, apologies. We don't have we've had a focus on a rental section for the presentation for HDC. So happy to resolve that next year. So we do have various intents to apply processes. Some of us have completed our intents to apply. Some of us are open currently. King County, we're open currently, and we really encourage you to submit. It really is useful data and information. It's not a prerequisite this funding year, but it is very useful for us to know what's in the pipeline. Seattle is having their own. Arch has over 71 million from 11 applicants, and Skip has those available for another few days. Typically, and last year proved the point, we receive more than 3 times the amount of applications relative to the funding available. So given the large demand, we encourage folks to reach out early, engage in conversation, and participate in everyone's processes for consultations or for King County for our info sessions. Overall, we see a number of themes, and Rosie, I invite you to compliment if I miss anything here. But overall, I do want to recognize we are in a state that has a relative share of abundance regarding the political support and the diverse array of methods to fund affordable housing. I've been here 5 years now. I came from Indianapolis. Those resources are not available. And so the federal discussions and the federal cuts even have a more draconian effect in those communities. So we are I'm very grateful to be in a region that is really supporting this. But we are underwriting projects with the understanding that operating supports are very limited. We are trying to internally come to terms with what those resources are, and we recognize that there are projects being built right now that may not have the full commitments for operating supports. And with the proposed cuts to HUD and the vouchers, those available resources are going to be limited. So we need developers to build really solid budgets. We're going to be looking at and supporting the financial strengths of organizations. We anticipate there will be a lot of carryovers from 2024, projects that have received local funding that need state match, projects that had funding that are now encountering gaps. And we are going to be prioritizing projects that have strong feasibility and are addressing unmet needs. At the same time, we are continuing collectively to support community-based organizations in building assets and affordable housing for communities that have been marginalized. And we are going to be primarily focusing on addressing gaps through our annual funding rounds. So we understand that each funder has some discretion and some different practices around considering project gaps that happen after award. We also want to highlight and direct people to the CHIP the CHIP program at the state that received a new allocation of funds and will be administering a funding round in September, or simultaneous with our funding round. So CHIP funds are going to be available and a responsible match to address gaps. We collectively have been working on developing, and we're going to transition to sharing some of the underwriting standards that we hope will help simplify and articulate the criteria that we are looking at in underwriting our projects this year. And for that, I'm going to toss it to Patrick and Tina.
Yeah, thanks, Nate. Continuing on that, I think we all acknowledge that over the past several years, there's been project financing is getting more challenging with unexpected funding gaps, more stringent investor and lender requirements. So in response, we have come together to refine our approach to some of the underwriting and ensuring that we can effectively assess and support projects that are well positioned to secure the financing needed in a timely manner. So to do this, we've identified a few benchmarks that the local funders can use to evaluate applications. These benchmarks are going to be included in each of the local funders' respective addenda to provide clear and consistent guidelines that can help streamline the funding allocation process for either an individual funder or when requests are made to multiple funding partners. This approach is designed to align our resources efficiently, strengthen the financial viability, and support projects that can stand the test of the evolving market conditions. And we look forward to working together to implement these underwriting benchmarks together and also make it an impactful, well-funded projects. So diving into some of these specific underwriting parameters, specifically, as I mentioned, we'll be asking developers to incorporate these recommended benchmarks. However, we do want to accommodate and acknowledge that every project is different, every sponsor is different. And so if you have reason and validation that can justify an amount or a value that deviates from this recommended benchmark, you know, above a floor, below a ceiling, or excuse me, vice versa, that or outside one of these ranges, we want to be open to understanding that, but we want to also name that things have changed and that certain known or expected parameters are different now. So I'll start here with on the for tax credit projects, tax credit pricing, investor appetite has changed. So we're looking towards sponsors to be submitting applications that have tax credit pricing in the range of 80 to 85 cents. We know there are some projects that are not able to achieve that 80-cent mark. There's also some that exceed that. And so we're wanting to set that as a benchmark and a range. And I think each individual funder is looking for then the LOI to back up that pricing that you're including in your application budget. Next, I'll go into some of the debt terms and expectations there. On the construction loan side, looking for a construction loan to be based off of an index of the SOFR plus 200 basis points. Again, if you expect a lower rate because you have a great banking relationship, wonderful. I would love to see the LOIs to back that up. On the permanent loan side, be looking for permanent loans to be sized approximately 200 basis points above the 10-year treasury. At the time of application, we all know those loans change and none of these loan terms end up being final until you're in that closing window of the last few weeks before closing. So this is our best known number when September when the applications come in. So again, looking for the LOI to support that. We're also hearing that the lenders' debt coverage ratios are changing. So we're looking for people to size their senior debt at a 1.2 debt coverage ratio number. And again, if you do have debt, per must pay debt in your deal, please provide your LOI to support your assumptions there. And then finally, wanting to understand and be prepared for the uncertainty in the construction market, both labor and material sides of things. We're looking for at your initial application of a floor of 10% construction contingency there, 15% for rehab. Again, if you've got information, if you've been maybe you're most of your way through your permit submission process and there's maybe less uncertainty, I think that's where individual funders may consider lower than that range. So again, looking for specific details from your project and where you are in your project feasibility to understand why you're using the value that you are. And I'll pass it over to Tina to go through some of the additional standards.
I realize I didn't introduce myself last time I spoke. I'm Tina Ilvenen, Housing Finance Program Manager at King County. So just wanted to continue on these underwriting standards. Maximum rents, we would like those to be below market rents, and we would like you to know exactly what the market rents are for your project based on a site-specific market study, maybe a rent comp study if you don't have an updated site-specific market study at the time of application. But we do want to make sure that the rents are at least 10% below market rents. And if they're not, we would like to know why. We do realize that incomes have gone up, and maybe the maximum rents that you could charge at the project are right at market rents, and this is an affordable housing project, so we would like the rents to be below market rents. Operating expenses, we've looked at some data, and 8,000 per unit per year is our recommended benchmark for the floor. If you're using something lower than that, please provide documentation based on actuals, not just a note that says based on actuals, but documentation that's based on actuals of why your project will be utilizing operating expenses that are lower than expected. Maybe there's something different going on in the operation of the project that would be saving money that we'd like to know about. And we're expecting a higher floor for homeless projects that include services. This 8,000 per unit per floor is 8,000 per unit per year floor is based on what we've seen so far, but we are still looking at data that we're pulling from WeBars on actual projects and analyzing that still. Residential vacancy recommended benchmark is 5%. If it's more or less, please provide a justification on why you think it would be more or less. And then the escalation of expenses should be a minimum of 3%. If it's more or less, please let us know why you're planning that. And the same on revenue, it should be a 2% escalation. And I would say this part of the performa is really important because it plays into the financial feasibility of the project. I would also mention rent subsidies. If you're including those in your performa, please show us that you have a commitment for those, or you have a plan to get a commitment for those. And this is important because if your incomes or expenses are off, then the amount of the permanent loan that you're expecting to receive may also be off, and it may create a gap. And we're trying to look at projects that are financially feasible all the way around on both the capital side and on the operating side. And that's all I have. I'll pass it on to the next speaker, I believe is Jackie.
Yep. Yeah, I know that was kind of a lot. I hope folks are hanging in there with us. I'm Jackie Moynihan. I'm a senior policy advisor at the Washington State Housing Finance Commission. The commission being your state housing finance agency, we are connected to the National Council of State Housing Finance Agencies and CSHA. And we do participate in a group that tracks federal activity. And so last week,
I participated in their most recent phone call. So this is really a pulse check. This is what we know, I think, as of right now of available information to us, and thought it would be a good time to give a little more details on some of the work that's going on that both patients and Rosie alluded to earlier at the start of the presentation. So on the federal side, there is the tax bill. I think folks probably have been tracking and hearing a lot about the tax bill. We do know that there are 3 provisions related to the housing credit in the tax bill currently. So in the version that the House passed, that's under consideration in the Senate. And one of those is that the 9% credit would be increased by 12.5% for 4 years. Similarly, there would be a lowering of the 50% test for the bond 4% credit down to 25%. And similarly, that would just be over the next couple of years. These 3 provisions basically sunset in 2030 if they're passed as they are contemplated today. And then the third would allow credit agencies to provide a basis boost of up to 30% for properties in rural and tribal areas. One other thing that I'll note that was highlighted for us is, folks had been really concerned that the tax bill would have implications on private activity bonds or municipal bonds. And there is no such impact noted in the current version of the tax bill, but it is something that NCSHA and many other organizations across the country are paying close attention to and continuing advocacy to make sure that any changes this next go around don't negatively impact those resources for us. So in terms of timeline, what we have heard is that Senate members are meeting, they're having conversations. There's an expectation that there could be a markup of the Senate version as early as tomorrow, maybe more likely next week. We'll probably get some good summary communication from NCSHA once that markup is available. I think folks have probably been tracking from news articles that the expectation is that the Senate would do their work before they go into recess at the end of the month and try to get a bill in front of the president by July 4th. I think there's a lot of depends in there on whether they're going to get there with the negotiating that they need to do on the Senate side. So I think the caveat for this group as it relates to the tax bill is that there is still going to be probably some fluctuation and uncertainty in the tax credit market, depending on where the tax bill lands. So we can expect a little bit more of uncertainty on that front until we know what's getting passed. And then on appropriations, the big concern is certainly the HUD bill and the budget being cut pretty dramatically as proposed. So I think Rosie mentioned this earlier, like there's a proposal to eliminate home and CDBG, which has happened in years past. It's always kind of been put forward as like, maybe just get rid of that. So that fight is back again. But there's a lot of coalitions across the country that are highlighting projects and highlighting the good that has come out of those resources. So there's a lot of advocacy going on for those 2 programs. And then I think the bigger concern really is this proposal around consolidation of rental assistance programs. And so that really does include like the continuum of care, the emergency solutions grants, project-based rental assistance, and not just consolidation, but consolidation and some significant reduction in the amount of funding available, with an assumption that states would come up with the other half of those needed resources, which I think, as Nate mentioned before, not all states are well resourced to come in and fill gaps when the federal government is not there. So things to continue to watch. But we did hear from NCSAJ, which is a learning for me, is that an appropriations bill cannot in and of itself authorize a new block grant program that would require congressional action. And there's I think some skepticism about whether Congress would be in a position to be able to put forward authorizing legislation for a brand new block grant program. Also with lots of questions around how would that even work? So I think stay tuned as there's more conversations and people know more. I think we'll try to keep, when we're showing up in meetings, be able to pass on knowledge that we're getting from our partners doing this work. But that's kind of as I know it today on the federal stuff. So bringing us back down here to Washington and to King County, just a couple of points. Some of these were already mentioned a little bit earlier, but to kind of double down on some of these things, we are really elevating the focus on preservation, and it is really going to be a bit of work for us to balance both the needs of preservation and new construction. Certainly, if there are some additional resources that do come out of the tax bill, there's a potential option there for us here at the commission. But we are doing some internal work looking at our resources and our policies. So there'll be more coming, and we're going to want to engage with all of you. I believe HDC's Tax Credit Affinity Group that meets in a couple weeks. There's been some discussion about creating a smaller group to talk about preservation. So I feel like that's another avenue. Folks can keep their ears open for opportunities there. And then additionally, we really want to highlight and call out that we are all still committed to our racial equity work and outcomes. I think given the backdrop of executive orders and many other lawsuits and things that are going on across the country, I say this on behalf of not just the commission, but our funding partners here, that we remain committed and we are holding to our core values. And we're continuing to strengthen our partnerships with and in support of community-based organizations and BIPOC development capacity. Jacob mentioned this before, and I will also say it again, our values and our goals are really reflected in our policies and our prioritization of projects to meet those goals. So with that, I'm passing it over to, is it Rosie or Kelly? Kelly, you're here.
Kelly's here.
All right.
Thanks, Jackie. So according to KCRHA and the point in time count in 2024, over 16,000 people are experiencing homelessness, with 60% living unsheltered. You also know many current renters are experiencing cost burden. In Seattle, it's about 44% of our renters. Collectively, we do believe that homelessness is a housing problem, and we seek to continue investing in permanent housing as a priority in our communities. And at the same time, we have unfortunately experienced significant changes in the permanent supportive housing, operating, maintenance, and services environment for the worse in the last year. So I'm going to be using an acronym going forward that is PSHOMS. Forgive me for that. The skinny budget you've all heard of already, but it proposes to reduce and block grant COC through states. According to the National Alliance to End Homelessness, this would make PSH ineligible for ongoing what was COC investment, because ESG does not allow PSH as an eligible use. In addition, Seattle has not received any new COC PSH OMS in several years, and there are other threats to COC currently and on the horizon. You've also probably heard about the planned elimination of emergency housing vouchers, which is a major impact for all of our communities. Folks are working really hard to advocate to find a solution at the federal level, but we are all planning contingency. If we are to prevent homelessness for existing emergency housing voucher holders, resources will need to be redirected next year to address this challenge. This impacts other OMS and voucher availability, which will be extremely limited in the near term. You all know government budgets. All these governments that are here have experienced serious deficits and anticipate future deficits that result in tough decisions for funds that, among other things, could be deployed for PSH OMS and housing uses. And last, we are facing uncertainty right now with PSH OMS for projects that are under construction. It's very serious, challenging times. As a result of this, PSH organizations are encouraged to be very thoughtful and cautious before spending pre-development dollars on new PSH projects in these uncertain times. And we ask that everyone is staying in really close communication with your public funder partners for the next few years.
Thanks, Kelly. Taylor's going to close us out with an outlook of what the Commerce's priorities will be for the next legislative session.
Thank you, Nate. Yeah, our team is currently working on decision packets or legislative asks for the supplemental session next year. Again, our priorities around capital funding, but also a very strong priority is our preservation funds and preservation strategies moving ahead. One thing that I do want to touch on that's not captured on the slide here so much so is what Kelly was just talking about is the unprecedented cuts to operations and subsidies for permanent supportive housing. The state had a very large impact in the 2025 legislative session where the AHA PSH funding was cut drastically. And that's going to be a major impact moving into this next capital funding round on PSH projects. So a shameless plug here, the best way to address that is through grassroots organization, speaking with your legislators and your representatives and driving the focus back to PSH and the need for that. So part of our focus going into next year is going to be additional funding for capital and preservation, as well as the operating supports.
Thanks, Taylor, and thanks everybody on the panel. We did a great job of presenting our status, where we're at, what we're looking at doing this year. Patience, I'll toss it back to you and however you want to facilitate questions that may come up.
Yeah, Nate, thank you. And thank you to the panelists for just the comprehensive overview, the ways that you are handling the complex funding landscape, given some of the anticipated gaps, but also the emphasis in the abundance we have. We did not acknowledge that this year, as hard as legislative session was at the state level, we have $600 million investments in the Housing Trust Fund. We've got an additional $100 million in the CHIP program. So there's so much resource in our ecosystem, and how do we leverage it well? And the exemplary collaboration we have amongst public funders is really giving us all hope. So we're going to open the floor for discussion and questions. This is your time to do that. I do have some of my own questions, but I'll ask that folks raise your hand, unmute, jump right in. But as we wait for folks to step into that, the first question I have is for Arch. Patrick, I know this is a time when each of the jurisdictions should likely consider their own increase in parity in terms of contributions. Could you speak to that overall for the Housing Trust Fund, whether that's this year or the coming year, and how do folks in the affordable housing community support that?
Yeah, so each of the Arch member cities are voluntary members of the coalition. They both contribute voluntary amounts of their general fund dollars to our dues as well as to the trust fund. So we are tracking to some of the metrics that they've set forth for themselves over years and have tracked that over time. And typically the awards are usually approved in prior years' budgets. And so those budgets are often set in summer of the year before they're advertised. And so I think that So that's a little bit of the process side. I feel like the work that HDC and others are doing to organize with the East Side Affordable Housing Roundtable is a great way to begin some advocacy and understanding up there, and then also connecting with directly with city councils and city leadership to grow that investment. And then there are communities that are dedicating specific resources, including Bellevue and Issaquah, to grow their resources for affordable housing. And there have been some new legislative tools that might benefit some additional resources in the years to come, including some REIT flexibility. So hoping that amount available will grow in years to come, thanks to the hard work of the legislators here in the 25 legislative session.
No, absolutely. Thank you. Questions from others? Claire, I have a question for Skip on the $3.5 million in funding. Could you just speak a little bit more to the priorities this year? I know you have areas of emphasis per funding cycle.
Yeah, happy to. So the executive board adopts funding priorities every year, and they often will make small minor tweaks to it. Our funding priorities are basically from applicants. We want to see that there are a handful of these items included in the application. And some of them conflict with each other. So for example, we have a priority of both preservation and home ownership. We have low income rental as a priority at 0 to 30% AMI, supporting households transitioning out of homelessness. Other funding priorities include collaboration, community connections and engagement. If a project is addressing the disproportionate impact on housing cost burden in South King County. If the project's promoting economic opportunity. Geographic distribution is a big one for us. So all of our cities have contributed funding, 11 cities. However, projects that skip funds can be outside of those cities that are funding it. So we do include a sphere of influence map in our RFP. But really the long-term goal is that we are seeing a skip funded project in all of our skip member jurisdictions over the next 10 years. That is the goal. And that's the commitment to the councils that I've been relaying to them. And so opportunities like this to highlight that the skip funds are here really is important for us because we are such a new public funder. So as much as folks can get the word out that this funding is here, and it does continue to grow every year, will really help us address those needs for our councils. So thank you.
Thank you. Yeah, it's an incredibly hard job to have all of the jurisdictions represented, but I have seen the intentionality that you all hold in investing in the projects. Philippa, do you want to voice your question here for folks to take that up?
Sure thing. So is there a piece of the Seattle Office of Housing pot for buying down debt on troubled projects that are converting or have converted? And is that, and if there is it competing with the new construction?
They're separate pots. They are not, it's not competing. And our definition of stabilization is actually for projects that have already converted to perm but are struggling to meet their debt service. So it's a buy down of debt. However, you do bring up a good point. There are buildings that are still out there that have yet to convert to perm that are in our pipeline, and we do have to get them there. And it does come out of the general capital pot. So, but what we have available, that 100 million, Most of it is levy, so that is not at risk. So no, it won't be competing.
So is there a specific pot size for the preservation dollars that's in excess of that 100?
Preservation is eligible to come out of levy. So
Okay,
it is sharing with the preservation. So
got it. Thank you.
you're welcome.
Thank you. That's a great question. So Rosie, you're saying there's no breakdown in terms of allocation within that $100 million specifically for new capital construction dedication, and then continue to support the projects with gaps. Could you just clarify that for me?
Correct. There isn't. There isn't.
Okay. Thank you.
But I will say that levy is not projects that are currently under construction and or like in that middle ground place in service are not eligible for levy, so they would not be able to utilize those funds in the first place. So
yeah, helpful. Thank you.
Welcome.
I have a question for the TOD funds for East King County. The $5.8 million. Are these funds structured to roll over? I know in the past we've had dedicated funding by geography, and sometimes those funds stay in the pot. But could you just tell us about utility of the funds, timeline, and what are the characteristics there?
Yeah, so in the 2025 budget, they allocated several set-asides of our TOD funding. The 5.8 million, there was actually 8 million. We've committed a portion of that 8 million that was set aside for East Side projects. There's no guarantee that the restriction will stay the same in the next budget. So I can't offer a guarantee that would that reservation would stay the same, but in all likelihood, it will. So we expect that we'll likely be able to commit those funds this year in this application cycle. We don't expect that there's there'll be a lack of qualified applicants to invest in that geography. Good question, Michelle. Michelle, do you want to voice your question? I can also read it.
Well, I can just say the EDI portion that you guys are making available this time for that Tina mentioned, I think with 11 million. Is that actually the 11 million all for housing, or is that 11 million housing and the non-residential components split?
There is. It's a good question. I believe we're fine tuning right now the restrictions. There's 9.5 that's solidly just for housing. We have 2 million that is available for housing or community facilities, and we're working on defining the criteria. We would like for those that 2 million that's available for community facilities to be restricted and targeted for those, because we do recognize that nonprofit facilities in housing developments are really desirable and need financial support. So watch for clarity on that.
Thanks.
That's great. Any other questions? Well, I have one for the Department of Commerce. And Taylor, thank you for the shameless plug for new funding, because that is essential. But just wanted to understand your 60-40 biennial breakdown for the Housing Trust Fund, and how is that overlapping with the pipelining coordination? What are some key aspects for us to be paying attention to?
Yeah, absolutely. And thanks for the question, Patience. So overall, the strategy on that is for the 2025 legislative session, we were appropriated a total amount for the Housing Trust Fund. And I'm speaking specifically on the multifamily housing unit side. Our strategy there is we had approximately $500 million for the multifamily housing unit. And the strategy behind that is last year in 2024, through public funder coordination, a lot of projects had needs that were unmet because we were so limited in the funds that we had available to commit. So the focus on that was to approach that second year of the biennium under the assumption that we're not receiving any additional funds in the 2026 legislative session. So we wanted to build in a safety that we could still address the needs of the communities at large and have funding available for that second year of the funding rounds. So essentially all we did was we took the total pot of funds we had appropriated and split it out, 60% being allocated to the first year of funding, which will be our upcoming NOFA rounds, and then 40% of that balance being applied to the 2026 NOFAs. And so we've been in that plan has been communicated with all of our public funding partners. And I think we're all on the same page of why that split is necessary. So we don't run into an issue like we did last year where the funds were so thin, we weren't able to get to all the projects that we could have had we had the additional funding available.
That's great. Thank you, Taylor. And while we have you, could you speak to the urgent repair fund and where that is and application process for folks to be aware of?
Yeah, absolutely. So the Housing Repair Fund was an appropriation in the 2024 supplemental budget that provided funding for one-time urgent repairs. And it's a claims process rather than an application, and it's a reimbursement basis. So we reimburse actual costs incurred for urgent repairs on low-income properties. And there's two criteria to be eligible for the repair fund. One is you have to have an active housing trust fund contract, or you have to be a permanent supportive housing provider with a contractual obligation to another public funder. So there's a lot of yays and nays on the repair fund and what's eligible or ineligible. It would take me far too long to go through the list. So what I'll do is I'll put a link in to the chat to our repair fund page. So far, the portal opened on June 2nd. At the close of the first day, we had about 100 submissions totaling about $4.7 million in claims. Now, one thing that I do want to say is those funds are not all spent down. I still encourage people to submit their claims to the repair fund. We are addressing them on a first come, first served basis, but they are split out by a regional distribution. And I know I'm speaking to the King County group here, but there are still funds available. So I do encourage people to still submit claims. We were appropriated an additional $5 million in the 2025 capital budget, which we will be allocating out. So for upcoming, those funds won't be available until July 1st, though. So we're still working through the 2024 funds and getting those funds spent down, and then we'll start working on the new appropriations funds after July.
That's great. Thank you for that detail. And I think the volume of applications speaks to the operational funding need that we continue to have, and I appreciated you elevating that. There's a question from Ginger. Ginger, do you want to cover your question here?
Sure, thank you. I'm just wondering, from the state level, it was talking about 20% investment will be available. And it says at least 20% of investment in the buy-in for organization. If someone can talk about it, what does that look like exactly? Is that for housing or is that for community? Because if that's buy-in for community organization, first of all, we got to develop ourselves. So I would like to learn more about that.
Yeah, thanks, Ginger, for the question. It's a great question. So the buy-in for commitment is for housing. So we specifically target that to fund buy-in for organizations. And that's something that we factor into our application reviews. And when we're making our award decisions, that 20% of our awards are going to buy-in for organizations. we have an application process to be certified as a buy-in for organization through Commerce, and I will drop that link into the chat as well. But overall, so it's for the balance of state that 20% of our awards are going to buy-in for organizations. So it gets a little complex when we break down into the regional distributions or geographic that the state follows of the rural, urban, and then King County pools. But we dedicate at least that 20% is our goal that we're funding buy-in for organizations for housing developments.
Hey, so I just want to jump in here because so there's a capital funding that we've been talking about, but so there's also the community reinvestment program funding, which Ginger, I think that would be a little bit more appropriate to what you're looking at or what you were thinking of. So in our last in our last community reinvestment program funding round, which we are able to get, I believe it was about 50 million for the CRP in the last biennial budget. So right now we're working with our counterparts in the community, I believe in community services division, to work out how we're going to allocate that. So we will put out that they'll put out that NOFA I believe next month, but I can get back to you with the exact date. I have your email, so I can just follow up with you. But we do have a Black, Latina, Indigenous led agency support bucket for that. So that's specifically to build up the capacity for organizations that are doing housing and home ownership work, and then I actually I myself work with a number of other colleagues to process the buy-in for applications as well. So Taylor, if you put the link to the buy-in for application, or I can do it, if you fill it out and have any questions on what it would take to qualify as a buy-in for, you can just reach out to me and I can provide you with some clarity on that.
That'd be great. Cliff, if you don't mind to put your contact information there, that'd be great.
Sure.
Thank you.
I'll do it again. No worries.
Thank you both, and thank you, Cliff, for sharing that. We know that the CRP dollars will be getting out of the door sooner, so thanks for sharing those. Two final items I would like for us to just spend time on, and this goes back, Jackie, to some of the analysis you were sharing on private equity impact from the tax bill, and then to the standards that you've all set for underwriting. If the credit pricing really is being assumed at 80 cents to 85 cents for projects, which I believe has been the trend over the last 12 or so months, do we see that upholding with this budget, with a tax cut moving forward? Will that be current market conditions? Are we creating a barrier for the projects? And how will we evolve to support any gaps that get created?
I can get started with some of the discussions. I don't think we've got a definitive answer, Patience, but we've had an underwriting group kind of talking about that very issue. I think the best that we can do is name here in June of 2025, this is what we think the best are, though the range is different across the county. And based on what we know, it'll be different when applicants submit their applications in September, and it'll probably be maybe different by December when decisions, or January when awards are made. And so I think just by starting with the baseline variable, we can all know just which direction the trends are going and which way gaps may be going, or is there some additional cushion that gets built in if for somehow, some way prices go up. So I think it's just starting with a level set, and then we can all adapt together as a community as new trends emerge.
Thanks for that, Patrick. I guess we could all speculate on What would be the impact? What would be the value of the AHCIA provisions moving forward? And if they're kept within 2030, what could that mean for the market? But appreciate the proactive planning. Moving on to operating expenses, I mean, benchmarking those at $8,000 per unit per year. That baseline, of course, is not as applicable for PSH. Having worked on the levy in Seattle and the modeling that we were looking at, the pricing was slightly higher. Could you just speak to the insights of what this means for the public dollars we have today? Because that buying power is significantly here going to be reduced. And how do we, as we continue to bring in new resources, prioritize covering that operating expense? And I don't know who's taking the operating expense question.
I will just start an answer just by saying that we started looking at WeBars and pulling data from actual projects that we've seen. And the data is all over the place, and we've got to do more work to analyze what we're seeing and create subgroups of specific subtypes of housing. And we know the homeless operating expenses per unit are going to be a lot higher than 8,000 per unit per year. That's why we put that little note on there. We're not done doing our work on that. We are pulling and refining and separating and analyzing the data in more detail, so that we as reviewers of these applications can see what the actual expenses have been over the years for specific types of projects. And we would like the developers to do their homework also when they're proposing a project with certain operating expenses, and really understanding that number plays into all of the other numbers on their spreadsheet, and for it to be realistic and not optimistic, because expenses go up, and I haven't seen them really come down. And we have seen a lot of problems converting to perm, and this is one of the reasons why we wanted to put some parameters around all the numbers, not just the expenses, but around, be realistic and really look at, maybe, look at your developers' projects as a developer that has history with this, and how have they actually been running. So that's what we're trying to get at by doing this, is asking people to put a lot of thought into these numbers.
I mean, we heard from Kelly a little bit earlier about the state of OMS, particularly talking about permanent supportive housing, but just in general, the Office of Housing, typically, we don't really have deep pockets when it comes to operating support. We are capital, all day capital. And so with that being said, I think there is a little bit of a blind spot, or a place that really does need more help, and maybe more looking at it. From the capital side, we're trying to come at it from, we have to be better underwriters, right? We have to be better at the front end of how we model our projects, and make sure that what we are modeling can actually be performed. So that's really how we are trying to solve for the operating shortfalls that we are seeing our portfolios experience. Another one is trying to put and extend a lifeline in terms of allowing applicants to come in for stabilization. What I will say for those of you who are interested in applying for coming through or applying in that stabilization bucket, we are going to tailor the application for the buckets that makes sense. And we're not trying to make it as maybe as robust of an endeavor as like a new production or new construction project, but so there will be a little bit of a difference of what we're asking for and the level that we're asking for modeling and those types of things. But yeah.
One last thing to add to that is, a clear area of that challenge for operational viability of PSH is King County Housing Authority is not going to be advertising any project-based vouchers this year with the Arch or King County NOFAs. And so I think that again goes to stretch the viability of some of those projects. So a little bit back to the warning of being aware of how much pre-development funds you're committing to projects in a time when that resource is not advertised as an available resource to be awarded this round.
Well, you are modeling your underwriting for projects to be successful. We're seeing that, and you're doing it with limited resources, right? We've had a long-standing gap in our financing for operating supports. And I think it's a time for us as a region, as a state, to continue to think about how we redesign, redeliver, or shift really how we deliver housing by the ways that our funding sources help support projects in a comprehensive way. We're not spending enough time here talking about the gap that's been created for permanent supportive housing, and I think we should continue to raise alarm on that and think together about how we invest more robustly. We're coming up to the top end of time. This 90 minutes always feels shorter because of the insights that each of you bring and the incredible work that's underway. I will ask panelists to close us off with lines of hope. Nate, I'm going to hand over to you first. I know Rennie brought up a question here or shared resources in the chat, but Nate, over to you in closing us off here.
Thanks, Patience, and team. Please be ready to offer your comments of hope. I'll share my sweatshirt with y'all. It comes from Indiana, and it says, "Safe, affordable, accessible, discrimination-free housing for all." This is a universal appeal and a common claim that we're all making, and everybody has. Housing is a human right, so we're grateful for the partnership with all the public funders and we really lean in to support you all doing the hard work on the ground at building and maintaining our affordable housing stock in King County in particular. So thank you so much. Team, anybody else want to chime in?
I'll jump in here, Nate. From the States, we couldn't do what we do without all of you, and we're all in this field because we have a shared passion. And Nate, you summed it up beautifully, that housing is a human right, and at the end of the day, that's what we're all here to do.
Well, that's hard to top. Thank you both so much, and thank you to our panelists.
Thanks for the invitation, Patience.
Thank you. I'll hand over to Kate. I know Rennie has an announcement, so Kate, I will leave that in your great hands.
Wonderful, thank you. Yeah, we were hoping to have a few minutes for member announcements. Rennie, do you want to pop on real quick and speak to the RFP?
Yeah, sure. I mean, I
put most of it into the chat, but we're just working on finalizing the language for our Federal Way TOD RFP. There are 2 of the 4 sites at our Federal Way downtown transit station. We've partnered, of course, with the funders on this call, including the county, who are pre-committing funds to this and working really closely with the commission. So we are very much looking forward to all the great responses to the RFP.
Great. Thanks so much, Rennie. And thank you, Nate, for adding in the other RFP from King County. Yeah, there's a lot of opportunities out there. We all still want to continue to build housing in our community. So thank you very much and have a wonderful weekend.